Today, I'm going to go over how disregarded entities like single-member LLCs and revocable trusts can streamline your 1031 exchange, and the mistakes you need to avoid. A disregarded entity is a separate legal entity, but is not separate for federal tax purposes. In other words, for IRS reporting, it's treated as part of its owner. Examples include single-member LLCs, revocable living trusts, certain land trusts, and even community property arrangements between spouses in community property states. The structure helps investors keep liability protection while maintaining continuity for tax reporting. The same taxpayer rule is the foundation for any 1031 exchange. The same taxpayer who sells the relinquished property must be the one who acquires the replacement property for tax purposes. With disregarded entities, the IRS looks through the entity to the beneficial owner. That means if the underlying taxpayer is the same, even if the name on the title changes between a single-member LLC or a trust, the exchange still qualifies. Disregarded entities give taxpayers flexibility and protection. Many choose to hold each property in a separate single-member LLC to isolate liability while still meeting the same taxpayer rule. In community property states, even a two-member LLC owned by spouses can be treated as disregarded, keeping the tax benefits intact. These structures allow you to both safeguard assets and preserve tax deferral during your 1031 exchange. Next, here are some real critical things to take in consideration. Electing corporate tax treatment for your LLC, for example, means it's no longer disregarded. Changing ownership mid-exchange, like turning a single-member LLC into a partnership, can also invalidate the transaction. And if your operating agreement doesn't clearly reflect disregarded status, or if you overlook trusts like grantor or land trusts, you could run into problems with the IRS. The key is early planning and consistent reporting. Before starting your exchange, confirm the entity classification with your CPA. Keep operating agreements and tax filings aligned with disregarded status year after year. Always document your structures clearly and coordinate with your qualified intermediary, CPA, and attorney. A small oversight here can create a huge tax liability. Disregarded entities like single-member LLCs and revocable trusts can make 1031 exchanges smoother by providing liability protection while still meeting the same taxpayer rule. But mistakes like electing corporate status, changing ownership mid-exchange, or neglecting proper documentation can disqualify you. With careful planning and the right professional guidance, you can maximize both tax deferral and asset protection. If you have any further questions after watching this video, I would love to be a resource for you. Feel free to give me a call.